Hi, this is Patrick Henry, the CEO of QuestFusion with The Real Deal, What Matters. If you're in the process of raising money for your startup, you're an entrepreneur that's trying to raise their first round of capital, beyond a business plan, what are the things that are investors looking for in you? These are angel investors, these are super angels, family offices, even venture capitalists. What they're looking for is your credibility. Any early stage investor is investing as much in you as an individual and your team as they are in your business idea. Do you operate with integrity? Do you operate with credibility? Do you operate with a level of trust? They're also looking for the best investment opportunities where there's a good fit. That's something as an entrepreneur you want to do as well. Find investors that are smart money investors that can add value beyond the cash. And you also need to understand your critical milestones and the timing of where you're at from a product development. We're going to talk about all those things today, and hopefully it'll be helpful in your next financing round. So that really gets into the kind of part two of the webinar, which is really about you as an individual and how you position your company based on the business plan. First thing that any investor is going to look for is your credibility. The better homework that you do, the better job you do of analyzing your target market and your competitive landscape and how your product fits into that and how it's really different, the more credibility you're going to have. Are you a technical or industry expert in the area that you're going after? Do you have a track record of past success? That's something that is really critically important. That doesn't mean you can't be successful if you're a first-time entrepreneur. It doesn't mean that, I don't have this. Even in the case of business planning, maybe you don't have the business analysis done. Maybe you don't have the market analysis done. Maybe you don't have the thorough competitive analysis done. That's not a problem. It's just a problem if you don't eventually do it. And there's people like me and there's other folks out there that do this kind of work that can help you refine those stories. If you are in that boat though, it is helpful to have advisors or mentors or maybe a formal advisory board that basically you can borrow their credibility. If they believe in you and they can endorse you, that has a lot of weight with investors, especially if those people have been successful in the verticals that you're attacking. Who's on your board of directors? Are these people that are credible? Do you have any letters of recommendation? Do you have strategic alliances or partnerships with key customers or suppliers or other people in the ecosystem that you're selling into? If you actually do have revenue and if you've been selling your first product, do you have customer testimonials or any case studies? All these things are things to help build credibility with prospective investors. Have you established any initial business success? So if you have been talking to people about critical milestones and you've met those milestones and you met those milestones on time, that starts building credibility with people. And the biggest thing that I look at and most investors look at is, does this person even know what they're talking about? I recently met with an entrepreneur that wants to introduce a consumer level product, and he was describing to me how differentiated the product was, and there's not been anybody in the marketplace, and I looked on the web after our meeting and there were 15 competitors out there. Now that isn't a good sign. Either he hasn't done a simple Google search on what the competitive landscape is, or maybe those aren't real competitors, but you've got to explain to a potential investor why those people aren't relevant. And I walked away feeling like there wasn't a whole lot of credibility there or a lot of homework done. At the end of the day, an investor is investing in you and your business, and it's all about making money, but that means that it's also about, is this a person I can trust? Is this person credible? Do they have high integrity? I'm going to be writing them a check. I need to be writing checks, not only people that have good ideas, but with people that I trust. Are they passionate about what they're doing? Do they have a will to win? Do they have a competitive spirit? And are they willing to make the self-sacrifices necessary to get a business off the ground? And believe me, if you think that being an entrepreneur is a 40-hour-a-week job, you better think again. It's, if your desire is to have a lifestyle business where you can kick back, you may eventually be able to do that as an entrepreneur once you've had your business success, but building a company is tremendously hard work, and it does require a lot of self-sacrifice. Investors are looking at, do you have specialized knowledge, and are you doing a good job of protecting your intellectual property and protecting the value that you build? Investors want to believe that you're going to treat their money as if it was your own hard-earned money. You're going to be frugal, you're going to be responsible, and then they want to have confidence of your commitment to stick it out and deliver. This is kind of one of the unsaid rules in raising venture capital, is once you get your first dollar of investment from a venture capitalist, their expectation, if you're a founder or a CEO of a startup company, is you're going to be there and stick it out no matter what, even during times of adversity, even when things get really tough. If they make the decision to fire you, or as they say, put you in another zip code or another area code, that's at their discretion and their choice. But if they're making an investment in you, they want to believe that you're going to be there through thick or thin. Now, I'm not saying always stick it out. If there's a lack of integrity or some kind of shenanigans going on like that, you have to be true to yourself. But if it's just about things getting difficult and the business hitting some hard times, you have to have a willingness to stick things out and fix problems. So let's shift gears a little bit and talk about the investing food chain. This is really, in order that at least I can think of it, the easiest sources of investment revenue or investment compared to the largest and more difficult. I always recommend that you stay in the lower portion here, bootstrapping, friends and family, small business loans, before you bring professional investors or semi-professional investors, as some angel investors are, into your company, because that's going to change the dynamic pretty significantly. I think that angel investors, I put them in the category of somebody that can invest, $10 to $25 to $50,000 into a company. These are good sources of funds if you're trying to raise a smaller round, say less than $500,000. If you're raising $1 million, you're kind of in no man's land unless you have a super angel that really believes in your business idea. So I would say kind of stay in the lower portion of this unless you're really trying to grow a company where you're going to be raising financing rounds in, say, the $3 to $5 million range. Then you can start working with super angels. Family offices are very high net worth individuals where they've actually hired staffs to do investing for them. In some companies I've run and worked with, we have strategic partnerships. So these might be suppliers or ecosystem partners or customers in our business that they also do investing. Intel Capital is an example. In Entropic, Motorola, Cisco, Time Warner, Comcast, Dish Network, Cox Communications. These were all investors in the company, primarily on our Series B round, and they provided substantial credibility to the Entropic story, but they also provided a lot of connections and advice. They were definitely what I would call smart money investors. One of the newer sources of potential funds, and it can be either pre-revenue sales or it can be raising actual equity capital, is crowdfunding. If you've never heard of it, check out Kickstarter. They're one of the big crowdfunding guys out there. I think crowdfunding works a lot better in selling to consumers, so B2C plays as opposed to B2B plays. But that is a potential source of capital for some companies. Then you get into really the more formal professional investors, venture capitalists, private equity, and eventually, if you're fortunate enough, being able to take your company public. Venture capital, I think, is the most traditional source, but there's a lot of secrets and myths and realities about raising VC funds. You can check out my blog site at QuestFusion.com. I've written a lot about that. But if you get the right venture capitalists that have the right attitude, that have experience in your verticals, and they're not purely a financial investor, they can be a great source of capital and also be a good catalyst for subsequent rounds of financing if you get the right people on board. So this is really about the food chain. I don't know how many of you have kids or enjoy, Pixar movies, but this is Shark Tales, where the boss is describing to the little fish, where he fits in the food chain. And I think one of the key things as an entrepreneur, you need to be confident but not cocky. You need to be convinced but also receptive, and understand where you fit in the food chain. And if you're trying to raise money, you need to make sure that you pay the proper respect to the people that you're trying to get money from, and continue to show that respect to your board members, to your investors, even as times get difficult. The other thing to understand about investors, especially when you get into the professional investors, these are family offices that have a staff, some angel investors, some super angels, definitely venture capitalists. They have a specific return on investment and internal rate of return they're looking for their funds. And if you don't know what those terms mean, you can look them up on the internet. But basically, return on investment is the total dollar return over a period of time. Internal rate of return is a percentage on a basically annualized basis that you're making on your money. So one example I found on the web, as a venture capital fund, if you can return 3x on your portfolio before management fees, that delivers a 2.25 to 2.5 net of your investment. Over 5 years, that's an 18 to 20% IRR for your limited partners. So if that doesn't confuse you, what does that mean? Roughly speaking, early stage venture capital investors expect at least a 3x return on a 10-year fund. It doesn't work out that every company makes money. A third of the companies, maybe they go broke. A third of the companies, maybe they break even and make a little. So that means your best investments, that top third, need to make on average a 7.5x return. If you're pitching your company to early stage investors, you need to have a business model that can deliver a 10x return over a 10-year period of time. You don't have to do the math for them. They will do the math for themselves, but you need to understand the market size, the market growth, your market share. All those things are going to translate into your financial plan, and your financial plan is what's going to be looked at to make these decisions. And the more credible it is, the better you're not going to get a discount off of your numbers. But it's something that you have to keep in mind when you're trying to raise VC funds. If you're Series C and you've already had some business success and a lot of the early stage risk is mitigated, late stage investors might just target 3x to 5x because they're not going to get as many companies that go belly up. But typically if you're in an early stage situation, you need to be able to deliver this level of performance. And if it looks like it's questionable, you probably won't get the money at all. So what does this really mean? Your business model needs to deliver 10x to get interest and to get an investment. You have to quantify that plan and that you can deliver that level of performance. That's about the credibility, that's about the homework. You need to have a model that allows investors to put enough money to work so they can make a good dollar return. The venture capital industry has been under pretty dynamic change over the last 10 years, but especially the last 5 years, where most of the surviving companies are these mega funds, these $10 billion funds. And even if you have 15 to 20 general partners, you have to put a lot of money to work in order to get the dollar return to move the needle on the overall fund. This is providing an opportunity for smaller, angel investors and consortiums of angel investors, syndicates of angel investors, to kind of fill the gap of, smaller companies that need capital. But if you are going after the tier 1 VCs, you have to have a big idea with a big business model, and those are more challenging. Those are more difficult things to pull off, but there are opportunities out there like that. Let the investors do the math, but make sure you have a business model that delivers adequate performance for your target investors. I think the next key thing to really keep in mind is as much as possible, you want to raise money from what we call smart money investors as opposed to dumb money investors. Smart money investors basically have specialized knowledge in your product market focus area. So they understand the vertical that you're servicing. Maybe they've had some business success. Maybe they've sold a company. Maybe they've built a business. Maybe they have a great network within that. They can help you make introductions. They can also help facilitate future rounds of financing. And in Tropic, John Walechka from Redpoint Ventures was the seed funder of the company. He also led the Series A, or co-led the Series A. John has great contacts and connections, and he was a key catalyst for us getting our Series C funding round done, because Steve Bird at Focus Ventures at the time was somebody that he followed only certain early stage VCs into deals. He would co-invest with NEA, he would co-invest with Benchmark, he would co-invest with Redpoint. So if we didn't have one of those guys as an early stage investor, getting that later round done or getting it done under more reasonable terms would have been a lot more difficult. The tactics of raising money. As I said before, if you can avoid selling equity, do it. If you can get revenue instead of equity, even if it's pre-sales revenue or even if it's non-recurring engineering revenue, do that. If you can afford to service a small business loan and get debt, do that. Once you have made the decision that you need to raise equity, valuation is all about risk versus reward. And you want to mitigate as much risk as possible and operate kind of lean startup principles to make your dollar go as far as you can before you bring in this outside investment. Because at the end of the day, investors really don't care about your sweat equity. They care about the value of their money, and they care about making a return on investment. Yeah, they'll pay you the minimum amount they can to get you to stick around and work hard and try to make the business a success. There are exceptions, but generally they're going to try to grind you down on valuation and take as much of the company for themselves as opposed to it being for the founders, for the key people in the management team, and key employees. I think it's also very important to understand competitive valuations. But again, let the investors do the math, but this will help you in negotiating if you truly do have a differentiated story. If you've done your homework and you understand your market size, market share, market growth, and you show proof points of how that works out, that can also be very beneficial for you. Beyond that, I think the real tactics of selling a deal and raising money are about creating a scarcity model. If you can get multiple people interested in your deal and it looks like somebody might not be able to participate that wants to participate, that's going to help you with valuation and also help you get the deal done. The other thing is, you've got to find an anchor tenant. You got to find that key initial investor that's going to help set the valuation and help be the person that everybody else comes around in a syndicate to get your financing round done. So that should be the real priority in any kind of financing, is finding that anchor tenant. Timing is everything is what I used to say, but timing is everything almost, I think, in the case of financing. And what this is really about is, as you mitigate risk, your valuation is going to be better. Again, the more you can bootstrap, the more you can get from friends and family, the more you can maybe do with small business loans, the better. Because the status of your product development, as it gets more mature, that mitigates risk. Are you pre-product? Are you sampling alpha or beta samples to customers? What's been the feedback, or are you in production? What's the status of your revenue? Are you pre-revenue? Are you getting some development dollars from customers, which, even if that's small, it provides some level of confidence in investors that those customers are willing to work with you, especially if they're eventual product customers? Or do you have a single customer? Then you get into diversification. It's one of the funniest stories with two of the companies that I ran. When I got there, we didn't have any customers. So we got our first customer, and the board conversation changed from, you need to get revenue, you need to get a customer, to, you have a customer concentration problem. So nobody's ever satisfied, nobody's ever happy, but I'd much rather have revenue and a single customer and be working on going to multiple customers instead of the alternative. Once you have multiple customers for a single product, can you build out a product portfolio? Can you address adjacent markets? Can you sell more to the customer base that you have? That's how you ultimately grow your business over time. Valuation increases in step functions, and increase in step functions based on milestones, which I'll talk about in a minute. But I think one of the things that some people do is they get too grandiose and think they're going to service some massive horizontal market before they even establish themselves as a player. I think as an entrepreneur and a startup CEO, pitching investors or just building a business, one of the key things you have to do is stay laser focused on dominating a reasonable sized niche. This go big or go home really doesn't work. Even in the case of Amazon, Jeff Bezos did have a goal of eventually building Amazon the largest online retailer when he started the company. But for the first 5 to 7 years of the company, they just sold books until they dominated the book selling market. Then they moved into other verticals. Milestones are all about mitigating risk. And as an investor and as a company that's a person that's bought other companies, this is something where I'm always looking at. Anytime I talk to a CEO, I find out what their goals are. And then the next time I talk to them, I find out how they've made progress towards those goals. Have they mitigated technology risk? Is the product working? Have they got their first customer? Is the product in volume production have quality issues? Is the market really evolving the way that they thought? You're always going to have some level of risk, but as you start, addressing and eliminating and mitigating risk, the valuation of your company will increase, which also gets back to what we talked about before. The more progress that you can make before you raise outside capital, the better off you're going to be. The bigger percentage of the company you're going to be able to keep for yourself, for your co-founders, for your key team members. Smart investors will track your progress towards milestones. So be sure when you're communicating with prospective investors that you can hit or get close to the milestones that you set and communicate. So a summary, preparing a good business plan, which starts with the strategic planning process, is critical. You got to do the planning work. You got to clearly articulate the plan and know your audience. You have to establish personal credibility, even if it's borrowed, even if it's from, advisors, mentors, customer testimonials. The only thing you can't borrow is trust, credibility, and integrity. That has to come from you. And that's something that any investor is going to be looking at. And if you don't have those things, it's going to be real tough to raise money. Selecting the right investors that are the best fit for you, smart money investors. A buddy of mine that also has kind of an online training business focuses just on this area, helping customers or helping entrepreneurs and companies, startup companies, build lists of target customers that are the most appropriate fit for them. Having the right timing of raising your funds is also very important to get a good valuation and get a financing round completed. And you need to understand and articulate milestones, what they represent, how they mitigate risk, and establish credibility by meeting your milestones. This is Patrick Henry, the CEO of QuestFusion, with The Real Deal, What Matters.